Let me ask you this. If your business got sued tomorrow, could they come after your home? If you hesitated, even for a second, this might be the most important video you'll ever watch. I'm a chartered accountant, and one of my key responsibilities is to make sure business owners don't find critical gaps in their asset protection strategies, only after something has already gone wrong, because by then, it's usually too late. So I'm gonna show you exactly how your asset protection strategies should evolve as your business does. Let's start with your business in its early stages. But before I get to that, I wanna quickly give a shout out to today's sponsor, Design.com. If you run a business or you're thinking about starting one, at some point, you're going to need branding, marketing materials, and a professional looking logo. But if you're like me and have zero design skills, getting something that looks good can be expensive and time consuming. Design.com is an AI-powered design platform that helps you create logos, business cards, social media graphics, and websites in minutes. All you do is type in your business name and add a few keywords, and their AI instantly generates hundreds of logo options for you to customize. You can tweak and edit them as much as you want for free. And when you're ready, you can download high quality versions at a massive discount, up to 88% when you use my link. You can find it in the description box below to get started today. Now, back to the video. Level 1, when you're first starting out. If you're starting a business, one of the first and most critical decisions you make is to make sure you're structuring it right. And protecting your assets will form the foundation of that decision. So when you first start out, you either have a sole trader versus a company. And generally, people decide between the two. And I normally have to ask a few questions for the client to figure out which one is more preferable, the best situation for them, or best structure. And the situation that we need to ask, or the questions we need to ask, is the risks and assets they have personally. Yeah, so the risk they're taking, as well as the assets, the business venture, so the industry it's in. So why you need to ask the industry is because it's a risky business, then most likely the business will get sued. And as a result, you don't really want it in your sole trader name. So some examples of the industries would be like construction, for example. Construction industry are risky business because of the fact that when you do send an invoice out, it could be tens to $100,000. And on top of that, the ramifications on a mistake that you could make could be 10 times the amount of the invoice you actually sent out. So for example, if you cause defects in a project, which then resulted in the company being sued, they sue for damages, and it could be a result of the whole project itself, not just your small part of that job. So that's why construction is something that most businesses would separate out and move to companies. So one other thing that you need to look at is your personal assets as well. So personal assets is another thing. And I guess the last thing that you probably look at is, simplicity and cost. They're the main ones, I would say. Obviously, tax is an important thing as well. Tax is probably the last and most important thing that you should look at. Most people always see it as the first thing to look at, but as accountants, they generally look at the risk, the personal assets, the business assets, the industry it's in. So construction is a risky business. Professional services, medical field also could be a risky business venture, so therefore they usually set up a company. Sometimes you need to be a company to be able to claim business grants, such as like R&D. So setting up a company could be a better structure as a sole trader. Simplicity and cost. Simplicity is if you're running a business on your own, then yeah, maybe a sole trader makes sense because you want to keep things cheap. If you're a personal trainer, sole trader makes sense for you. If you're a personal trainer, but you have high ticket items that you sell to your clients, and if the client sues you, that could be a big damage to you and your reputation, then you might set up a company. But you got to look at the cost. So obviously, let's go through the quick rundown of the total cost. So let's bring this over here. For a sole trader, the pros, the cons. So for the pros, we're looking at it's simple, cheap, tax rate is good for low income earners. So I would say under $100,000. And that's the main reasons why it's good. In terms of cons, it's maybe too simple. So tax is high for over 100K. And sometimes I would actually say that 150K is usually generally not a good idea to have a sole trader. Obviously, no separation of assets. So high risk, personal assets, are tied, personal assets are tied in. So they're the biggest risk of having a sole trader versus, a company. And so for a company, we've got the pros and the cons. All right, so the pros for a company would be, let's just say, one big factor is the 25% tax rate, okay? If your income is quite high and you're making 135K to 150K plus on top for your business, then a company is better because you're capping your tax rate at about 25%, just as long as you keep the profits in the company. And a lot of people say, well, if you take the money out, then you end up paying the 47% or whatever the personal tax rate is. But if you're running a good business and you're actually running a legitimate business, more generally the time is that you keep the profits in the company so you can reinvest it and grow it even more. So keeping a low tax rate that's at 25% is actually a good idea. So that's one of the reasons why 25% tax rate for a company makes sense, and it's a pro. Another thing is the separate legal entity. So separate legal entity. Okay, so this sounds confusing, but what it really generally means is that it's created as a separate entity and it houses your business. Your personal assets are not tied into the business, and as a result, if the business goes into legal trouble, gets sued, I'm no lawyer, but most likely they're gonna go after the company rather than your personal name. And so your home and your personal assets have a level of protection and it's good. So that's why separate legal entity becomes kind of generally protects assets. Okay, so generally what I said before was that a sole trader is cheaper, but I have to say a company is still cheap. Relatively cheap to set up, relatively cheap to run as well. So I would say it's relatively cheap, but obviously not as cheap as a sole trader. It's still cheap. And one last thing of having a company, and which is a pro, is that it kind of allows you the ability to be able to buy and sell shares of that company. So you can get multiple investors. So it's investor friendly. Okay, and that's the main pros of having a company. Okay, the cons of having a company, obviously it starts, if you look at it, it gets a bit more complex. Then you have to lodge more tax returns. And some people can argue that for some people, it's a bit more costly to organize, especially when you compare it to a sole trader. All right. And that's pretty much the differences between a sole trader and company. So if I were to give examples on what's best, if you're running a small business that's like a PT trainer, then most likely you want to be a sole trader because all the income you make, you're probably going to spend it. You're not really going to reinvest it. And you're just starting out as a business, then a sole trader kind of makes sense. You want to keep the costs low. Your taxes probably low anyway because your income's low. You don't really have much personal assets. That's why a sole trader makes sense. Companies, on the other hand, a good example of setting up a company from start is that, let's just say you've been in the industry for 10 plus years. You could be an accountant or you could be a lawyer and you have operated in that space for quite some time. So you know that when you start out, you're gonna have a lot of clients that are gonna reach out to you. And most likely you may be making easily $200,000 to maybe even $500,000. You also look at your personal situation and you've got multiple assets. Some could be investment, could be a home. And so you wanna protect that as well. So a company in that instance is a better idea. And there are also two other things that you should probably consider as well when you're starting a business, which is avoid personal guarantees. So in the early days, lenders or suppliers might ask for a personal guarantee since the new business has little credit history at all. So be cautious of these. When you sign a personal guarantee, they can go after your personal assets as well. So be careful, speak to a lawyer when it comes to this stuff. The second thing, again, this is not legal advice, but it's to hold your personal assets strategically. So if possible, put major personal assets out of harm's way. For example, some business owners, if they have a spouse, would put the family home in the spouse's name. And the goal at this is to make sure that the risky spouse deals with all the business, and if they do get sued, they don't really have any personal assets, whereas the spouse has the assets in their personal name. However, because they don't really do anything that's risky, then they're less likely to get sued. Then as a result, there's a level of protection, a separation of personal assets versus the business itself. Lastly, what you could also do is have a company that's the trading company here, and then instead of having the individuals own these assets, have it owned under a trust instead. So now we've got this family trust that owns these assets, which owns the business assets, and so therefore it's actually separated from the personal individuals. So the individual will obviously control the trust, so individual 1 and individual 2, but then which is spouse 1 and spouse 2. However, then the trust is actually the ultimate owner of the company, the trading company, and then you have the company as the trading entity. And the reason why we do this is also not just for asset protection, but also just for succession planning and the ability to distribute profits as well. So the ability of having a trust in between the asset holding allows you to distribute the profits to the trust, and then the trust then disperses it between the individual or individual two, depending on their income. And sometimes it might not just be individual 1 and 2, but eventually when your kids grow older, then you might have multiple individuals as well, which could be, the kids as well. So that's something that helps out for succession planning as well as tax planning and the ability for you to have that flexibility to distribute your profits. So generally, as we move to you scaling the business and you're growing the business, that's where we start looking at separating some of the trading activities. And why we do this is to protect the wealth that you're creating, the growth that you're creating as well. So generally, we have that trust, as we mentioned before. We may even consider slotting a holding company in between. That's this here. And the holding company, the whole point of the holding company is to hold profits. Generally, sometimes if we can't put the company in there, we have a bucket company on the side. We could have a bucket company here instead of the holding company. That's if you don't want a holding company in between the trading entities. As you can see here, there's actually 2 trading entities. So as the business grows, say it's a construction business, you may decide to have a payroll company that employs all the contractors as well as the employees. And because there's a bit of risk and the business may not want to have that risk in one whole entity, they may separate it into 2. What you could also have is maybe even assets like, the forklifts, the machinery, all in that trading company too. So you could have payroll, assets, you could have leases because it's high risk, and you could also have, another business venture. So another venture that is high risk. So for example, if I run an accounting business and I wanted to set up a mortgage brokering business as well, I might keep that venture in another separate entity. The last thing is maybe even like same business, but different location. So different location, they may separate into another business as well, because you don't want the second business to bring down the first business, and that could happen. And that's why we keep the structure quite clean. We have a holding company in the middle, we have a trust, and possibly the last thing we might do is set up a trustee company as well. So generally, accountants and lawyers would ask you to set up a trustee company. The reason why we set up a trustee company is the fact that a trustee company is the controller of the trust, and having the individual as the trustee is generally a bad idea. And the reason being is because if the individual gets sued personally for their own, actions, for example, you go to the pub one day in the weekend, get into a fight, injure someone, that person sues you personally, and you're a trustee of your own trust, what would happen? The trust assets will be tied into the lawsuit, and then therefore they can go after the trust assets. And it's up to you to prove that the trust assets are not your personal assets. And it just gets all confusing. That's why it's always a better idea to set up a trustee company to control the trust, have a holding entity or a bucket company, so all the profits or the money gets either sitting in the holding company or either sitting in the bucket company. You could have one or the other, you don't need to have both. Some people might prefer to have both because the bucket company is for investment, holding company is just to hold the cash, but you can have the profits get paid up from the trading companies over to the holding company, or gets passed over to the holding company, then the holding company can pass it to the trust to give to the bucket company, or you can keep all the profits in the holding company. It's up to you how you want to do it, but this is generally the structure to protect your wealth, help you scale, and then also minimize the risk to ensure that activities that the business or the whole group start participating in doesn't affect what you've created up to today's date. So just to summarize, the reason why we like this structure is we have a trustee. If you do anything personally, it doesn't affect the whole business. We have a trust that is basically gives you the flexibility to distribute profits, and the trading companies will make the profits, and the profits then get passed to the holding company or the bucket company through the trust. And that's the beauty of having these entities. As your business grows, as the group grows, you will jump on different activities. Those activities start becoming a bit more risky because there's more money spent, there's more investments, as well as there's more contracts. So as a result, you want to separate it into different trading entities. You might not just have trading company 1 and 2, you might have 3 and 4 as well. And that's the reason why this structure allows for scalability, protection of the wealth, that you've already created, also separation of the assets that you've created within the business, which means that if something goes wrong, you don't lose the whole lot, you only lose a small part which you're willing to give up because it's separated from the business overall. And the profits are protected because it's sitting in the holding company or the bucket company through the trust. So great structure to have for stage 2. Okay, 3 to 5 years in business, this is where you start looking at level 3, advanced strategies. At that stage where your business holds a lot of value, you will start to consider different layers to existing strategies to make sure you protect your business, maximize the tax efficiency, as well as make sure that your activities are all separated so there's a level of asset protection as well. So in level 3, the main thing you need to consider is obviously the tax rates. So this will be 25%, this is 25%, holding companies at 25 to 30%, trust is NA. And it's really important to draw this out because when your business is doing really well, you want to make sure that your overall tax is the least amount that you're paying. So right now you can already consider and see that you're either paying 25% to 47% in taxes. And in this structure, we generally like to create a few other entities and duplicated entities as well for specific reasons. Okay, so generally you'll want a super fund. So a SMSF is generally created with a trustee company as well. Okay, a SMSF has an amazing tax rate, and that tax rate is 15%. As well as then you may have family members. You might have I number 3 and then I4 that could be mom and dad or daughters and son that have generally a lower tax bracket. So the tax bracket could be 30%. The reason why I call this level 3, even though most of the entities are the same, is that when you're growing in stage 2, you want to generally keep all the money or the investments within the business group. But when you start making quite a fair bit of money in level 3, you're trying to move the assets away from the main group and set up separate groups or entities to house those investments. So the key word that you want to know is investments. So you want to move some of your cash into investment structures. So you may have a bucket company that's separated. So you may have a bucket company that is investing in property and land. And you would also have an SMSF that is investing for your long-term growth as well, which then can also invest in land and property as well. And that's generally the structure you prefer, that you want to look at these structures because there's a 30% tax rate for the bucket company and SMSF at 15%, but these assets are separated from your business assets. So if something were to happen to your business overall, it doesn't impact your investments. And one thing a lot of people tend to do when they get to a certain size is they consider exit strategies. And if you have all your investments in that structure for your whole family group and all the investments are invested in your business, what generally happens is that when you sell your business, you sell your investments as well. So that's why it's actually a better idea in stage 3 is to start isolating those investments and moving them away from the general business group. And that's why SMSFs comes in, a bucket company with maybe even a separate trust. And then we also look at the tax benefits of doing that too. So a bucket company obviously has the same tax rate as all the companies out there, but SMSF has a tax rate of 15%. So we start trying to move some of the cash or the investment money that you have into long-term activities, which is using a super fund. Generally, you can't touch that money until you're 60, 65. So not everyone will put all their money into SMSF. And so that's where a bucket company and a trust is important. And a bonus structure is that if you do decide that you're not planning to sell and you want to, for example, start going overseas for your business, so you might just decide that, hey, you know what, I'm gonna go international. Then that's where you can create an international entity as well. That is probably related to the holding company, and it will come out here and it'll be an international trading. You create an international trading company, and there are generally a lot of benefits of that as well. But you got to be careful, obviously, because I'm not an international tax expert. But in some jurisdictions, the tax rate could be lower than our tax rate. So 25 to 30% is our company tax rate. Whereas I know in other countries, for example, the tax rate can be as little as 0 to 15% in certain places. So that's something that you might want to consider if you're especially going overseas, expanding in different countries for your business. It has to make sense though. You can't just set up an entity overseas, move all your profits in there, because that would be a tax scheme and you could get done by the ATO. But if you're actually planning planning to expand overseas, setting up an international company could be a good idea for you as well. So you can separate the activities over there and enjoy lower tax rate for your profits as well. And that's generally like stage 3. You're kind of doing the same things with stage 2, but then looking at the business group and having the investments separated out of the business group, because you need to allow for flexibility on selling the whole business as a whole, as well as keeping those investments separated with the business. So those profits that you can keep making gets pushed into those investment structures that have generally a lower tax rate or generally better for your family, because your family can own these separate from the business. And that's stage 3. So basically, asset protection isn't something you do once, then set aside and that's it. It's something that evolves with you step by step as your business grows. If you got questions about how this could apply to you or your specific situation, I would definitely recommend setting up a consultation with an accountant. I've left the link below if you'd like that accountant to be me. Otherwise, if you want to know more about companies or trust structures, check out this video. See you guys next time.